I'm going to do a couple of videos on actually real products, very specific, things that I find are very attractive right now, things I use myself that I will show you. I see a lot of videos out there, a lot of people talking, they always talk in generalities, they don't give specifics. I'm going to give specifics on what I think are a very good idea. And I realize that you could take this information and go to somebody else and have them put it together for you. Perfectly okay with that. If you want me to help you, I'm happy to do that. Hopefully you'll allow me to help you, but hopefully I'll show you something that you may not have seen before, but things that I think are great that are zero risk. And let's talk about why we might consider this kind of stuff. There are a lot of us, myself included, my wife and myself are in our 60s. We've worked very long, very hard. We've built up a nest egg of right about $2 million in our qualified account, our 401k, IRA, pre-tax money. Now we're in our 60s, we're looking at retirement, things of that nature coming down the road, and what I don't want is to go backwards. So certainly happy to chase the gain, but what I don't want is to ever see that 2 million go to 1.7 or even worse than that. So I am more focused on keeping what I have, certainly looking for some growth, but having no possibility of going backwards. So I recently just did another video on get out of the stock market now. I get a lot of pushback in the comments on that, but that's exactly what I've done. I've taken all my qualified money out of equities, out of the stock market, and it's all in fixed income vehicles. And we need to find the best fixed income vehicle so that, again, that 2 million never turns into 1.7 and can only go forward. So I'm going to show you a couple right now that I like, that I'm using, that I help others with, and you may also very well find it attractive because we got to find some place to put that money. It has to go somewhere. And again, I just don't want it in the stock market. What worries me most about the stock market in the near future, not so much the tariffs, although that's certainly something that could derail things. It derailed it the first time they came up, and now it's going to come up again, and whether that's going to create major turmoil. But to me, I'm more concerned with AI, artificial intelligence. Artificial intelligence is coming much faster than we ever thought. It's going to hit our doorstep really in the next 2 to 5 years, maybe even sooner than that. And what that will do, it'll have a lot of positive effects. There'll be a lot of, you know, which markets to go after that it will improve, then that's terrific. But it is going to create massive workforce disturbance, interruption. It's going to take a lot of jobs away. And when we take all these jobs away, it takes people's incomes away, and it creates a massive effect on the economy. But let's not get into that conversation right now. But that's really what worries me the most, and we'll see when it's coming and just how quickly it gets here. But it's coming pretty quick. But let's talk right now about a couple of different products. I'm going to do 2 different videos. This one is based on growth. The next video that I do is going to be a product that's based on guaranteed annual or monthly income. So 2 different things to look at. If you have a pile of money in your qualified account or outside your qualified account, you got an inheritance or whatever it may be, and maybe you don't need income. Maybe you have income from plenty of other sources, so you just need a comfortable, safe place for the money to continue to grow without it going backwards. That's what this product is. And this product is offered. And I only look at generally A+ rated companies, A++ rated companies. Don't want to have any risk there either. This company is Mass Mutual. We've certainly heard of Mass Mutual before. They've been around forever. The product is actually called the American Legend 7. So I don't know if some other financial advisors will see this and start looking into it and offer it to others. But what makes it attractive to me is all that I can do on. I don't know what it would make it attractive to you for, but what it makes it attractive to me is that we get some growth out of it. And the way this thing works is it's a 7-year product. So most of the stuff I talk about are 10-year products. This is only a 7-year product. So number one, we have to be in a position where we don't need the money for 7 years, which certainly in the qualified account, not going to be yanking it all out at once. It can certainly go for 7 years, and 7 years is not that long of a horizon. But what this product will do is it will give a cap on the S&P 500 of 8.5%. So in other words, based on the S&P 500, and there's a number of different indexes, but I don't use all the indexes you've never heard of. I want to stick with stuff I know, stuff I see on a daily basis. What this means is that whatever gain the S&P 500 has up to 8.5% will be credited to the account. If it has a down year, your floor is zero. You never go backwards. So you can go up as much as 8.5% or down zero. And what makes this product special or different than others is that 8.5% cap is locked in for the entire 7-year period. Most products like this will show you a cap, but a lot of people won't even tell you that they can change the cap every year. They can lower the cap every year. Don't want that either. This product has a cap lock for the entire 7 years of 8.5%. So pretty fantastic. And that's exactly where I want to be. And to understand just exactly how this thing works, so it's a point-to-point 8.5% for the S&P 500. So if you buy this product, and let's say you set it up on November 1st. So come November 1st this year to November 1st of next year, that's going to be the period of time that it's going to calculate whatever gain the S&P 500 has had from that first point to the second point, the entire year. You don't deal with daily or weekly or monthly stuff in between. It's simply that 1 year point to point, whatever the gain or loss has been during that time, it will either be credited up to 8.5%, or if it's a loss, then your floor is zero. So you don't ever go backwards. So again, that's exactly where I want to be. So let's take a little look at this on kind of what they show. These are the indices or the indexes that you can choose from. But again, I don't really want to get that deep in the weeds. I want to play with stuff that I'm very familiar with. And then we have a hypothetical look, and this is based off the most recent 10-year period. So when we talk about a hypothetical look, whenever we're looking forward, nobody can give you anything other than a hypothetical look because we don't know what's going to happen over the next 10 years. But what it's saying is if what has happened in the previous past 10 years, I'll show you some other examples in just a second, that's what we're going to base our assumptions off of. So you can see here, as it goes, that it grows based on what the S&P 500 has done. There are some smaller ones. The first one's 2.57. Then you got the 8.5. The S&P might have done really well, might have done 12 or 13% in those years, and you get the 8.5 credit. And then 6.41, there's a zero, there's a couple of zeros, there's more 8.5s. So yes, we may not have maximized our total return on the S&P 500, but what we didn't do is we didn't lose when the S&P 500 did lose. So it can round out in the end. And again, to me, at this point, that big gain, the biggest gain, is not that important to me. The bigger piece that I'm looking at is the big loss. I don't want the big loss. And if all of a sudden stuff goes sideways and the S&P goes down 15%, 20%, it's gone down as much as 30% or more at a time, that would be just catastrophic. It would make me feel ridiculous to have set myself up in that position where I don't have enough time for it to come back and recover and then grow from there. Now understand this point-to-point thing. Let's say the S&P 500 went down 30% during one of those annual point-to-points. Okay, so you went down zero, so you didn't go down at all. Your next point-to-point starts at where it is sitting at that 30% loss. So your next year will be a gain from that point. You don't have to wait for any recovery whatsoever. You start at wherever the lowest point is at the end of your point-to-point. So that's another very positive thing that I find in a product like this, that it almost lets us take advantage of a really bad year if that's the way it may be. So this chart will show you lowest 10 years, current 10 years, highest 10 years based in the last 20 years. So you can see the current 10 years, it annualized at 6.67%. I'm perfectly happy with that on my money, that I can get 6.6% without having any exposure to loss. And that's exactly what I'm contemplating. In a bad scenario, 4.86% also. that would have been a pretty bad 10 years. You probably would have done pretty badly if you were in the stock market in that 10-year period where this only brought back 4.6%. So again, that's just where I'm at on this, and this is for the growth part of it. I'm gonna do another video. It'll be my next video. I'll get it out very soon on a guaranteed monthly income, where if we're looking to set up into retirement and have basically our own Social Security check or our own pension check coming in, this product I find very good to do that, and you'll, I think, find it very good as well. So I hope you found this helpful. I'm happy to help with any of this. If you want, reach out to me. Just give me a call, send me an email. I'll get very minor information from you. I'll do an overview for you specifically in your state at your age and see if this stuff makes sense for you. But for me, just having growth with zero risk, I'm all for that. So I hope you found this helpful. Have a fantastic day.